If you understand the difference between a sweep of liquidity versus a run on liquidity, you will have an extremely advanced understanding of trading. Now, I'm going to guide you from A to Z here, so let's dissect everything. Let's start off with what is a sweep and what is a run on liquidity. Now, in both scenarios, let's use a bullish example where we trade above a swing high. And how we react above that swing high will tell us if it's a sweep or a run on liquidity. Where if we sweep a swing high, that means we are trading above that swing high, and then usually we immediately retrace back lower to then target the opposing liquidity, where we will actually turn from bullish to then all of a sudden bearish. Where if it's a run on liquidity, we will continue in the intended direction when we trade above that swing high. Meaning, once we trade above that swing high, we do not all of a sudden continue lower. No, we actually continue higher, targeting a higher swing high or another premium array. Now, usually this is very well seen in hindsight. I think everyone can see it in hindsight, but we are trying to see how we can spot it in real time, how we can anticipate it. That is where we need the following understanding. So I'm going to remind ourselves of what we went over in old videos as well, how the market moves. The market does one of two things at any given time. It is either offering fair value or it is seeking liquidity. Well, when we continue higher in the market, we create buy side right there. There is buyers getting involved. Now, after we make a retracement, we get sell side right there also getting involved. So buyers and sellers right here have a fair chance to get involved before we actually move higher. So what is the market doing at that moment in time? Well, it is allowing sellers as well to get a fair chance to get involved. It's offering fair value. Then once we move higher, and this is the swing high right there that we talked about in the first example, then if we now want to continue higher right here, we have offered fair value right there. So right now, the only area where we have not offered fair value just yet is above that swing high right there. Because this area right here is only where buyers, again, got a fair chance to get involved. So how far can price actually retrace? Well, towards the fair value area that we have right there. Because if we are offering fair value, then the only place where we can now offer fair value is the place where we have not offered fair value just yet. Stick with me, it's going to make a lot of sense. Where the gray area right there is the only area we can currently retrace to then still continue higher off of that. Because that area is where price can now offer fair value to still continue higher. This fair value area is also what you may know as a mitigation block, an order block, and a breaker block. But what if we are not offering that fair value? And you can probably see when we are offering that fair value right here, we can continue higher. In other words, we can run that liquidity to continue higher as well. That is when we are offering fair value. But what if something like this happens? We have fair value area right there, and we are coming back into this gray box quite deep right there. Well, the only place where we could have offered fair value was again above that high right here. There is no reason to retrace very far at that moment in time because we have already offered fair value. And how the market moves is again one of two things. It's either offering fair value or it's seeking liquidity. So if it's not offering fair value at that moment in time, then what is it doing? It's seeking liquidity. Seeking liquidity in the form of what? In the form of this swing low right there that we left behind. So that means that we have a sweep of liquidity to actually continue lower instead. Now, when I talk about liquidity, it's always going to be a swing high or a swing low. So if we are seeking liquidity, it's a swing high or a swing low. Those are your liquidity points. So let's look at them side by side before we move to real chart examples right here. This again, that seeking liquidity, and this is that offering fair value. The first one, seeking liquidity, is again that sweep of liquidity as well, where this is the offering fair value is associated with that run on liquidity. Here we are on GBP US dollar on the 4-hour time frame. The higher time frame premise is to already continue lower. So I'm already looking at lower prices actually. So that's quite important to understand. So we won't go over the higher time frame fully in depth right now. If we take a look at this right here, we can see we have this move lower right there. After that move lower, we have a move higher sitting right there. Then we have a move lower again below this low sitting right there, that swing low. This creates that same fair value area that we discussed a little bit earlier, sitting right there. And why do I mark out the bodies and not the wick? That is because this in itself is now a breaker block as well. It's that 3 swing movement of that fair value area, which is seen a little bit different. 1, 2, 3 is your typical one. Order block and mitigation block is this one. Then the second one, the second variant is this right here. And that creates your breaker block right there. And the reason I mark out the body and not the wick is because the wick, the lowest point of that wick, is not overlapping with a fair value gap. So that's exactly why I mark out the body. Now that body is where we can now retrace back into to continue lower from, because that is the fair value area. If we are offering fair value, we should already continue lower right there. And we can see that we have a sting into it right there to then continue lower towards this swing low right here. This is where it becomes very important, because right here, if we want to continue lower, we should ideally be running lows, because running lows again means that we will continue in that direction. Whilst if we are sweeping lows, we might get an opposite move. So then how do we now determine if this move below that low right there is actually a sweep or a run on liquidity? Once we take out a certain liquidity point, we need to ask ourselves, where is again that fair value area? So here we are on the 1 hour, going down a singular time frame to go into more detail. This right there is again that fair value area right now. So if we want to continue lower, then this fair value area is what we can continue lower from. Any retracement above that is quite suspicious, as in we should not have to do that. So if we retrace very deep into that gray area, it becomes more of a potential sweep of liquidity, not confirmed just yet. The first sign that we oftentimes have is when we take out the liquidity point. If it's a sweep of liquidity, we will not have a fair value gap exactly overlapping with the liquidity point that we just took. So for example, right here, we on the 1 hour time frame take out that swing low, the liquidity point. We do not create a fair value gap exactly overlapping with this low right there. That's the first sign. If we run liquidity, then as a general rule of thumb, we do create a fair value gap exactly overlapping with that low. That's again the first sign for a run versus a sweep on liquidity. When we have a run on liquidity, we do create a fair value gap exactly overlapping with that low. It's a general rule of thumb on what creates the difference between a sweep versus a run on liquidity. But that's not the only part, because like we saw on the 4 hour with that earlier fair value area that we have right here, that breaker that we talked about, then we see we also do not have a fair value gap exactly overlapping with this low right there. So what is then another sign? Well, another sign is again that offering fair value and that's seeking liquidity, like we talked about as well. But to understand the third sign, we need to dive deeper into what it actually means to seek liquidity and why it happens in the market. So the theory that I like to use right here is, if we are seeking liquidity, then how is that going to be done? Whose liquidity are we actually looking for? Well, we are looking for liquidity that has an impact on the market. That's actually a lot of liquidity. So we're not necessarily looking at liquidity from your neighbor Joe. Doesn't really matter. Those two lots, with all due respect, they don't really matter in the big scheme of things. But if we talk about certain financial institutions, bigger hedge funds, then that does matter. Because let's say one big hedge fund or one central bank even is trying to get involved in the market, trying to do a transaction, then there's a limited amount of orders that we can have in the market. So we need to free up some kind of orders to actually look to get involved ourselves. And when I say ourselves, I'm not referring to me. My liquidity also is extremely irrelevant, but I'm referring to central banks, bigger financial institutions. If they want to get involved, then they can't just simply click buy or sell at any given moment in time. No, they need to free up liquidity to actually get involved to a counterparty. What does that mean? Well, if we are looking to sell, there needs to be an opposing buyer to our sell order. If we are trying to buy a car, someone needs to sell us that car. If we want to sell that car, someone needs to buy that car off of us. We can't just sell and buy through thin air. That's the same exact thing in the market with orders. So if the theory is correct and the bigger market maker right there has a plan in mind on getting involved, then what does that actually look like? Well, let's say the market maker wants to buy right here. How would he go about that? Well, what kind of people are working usually at financial institutions on a very general rule of thumb? Trend traders. Trend traders like to buy on breakouts. Very easy. Just buy on the breakout right there to then place the stop loss above recent swing highs to then continue lower off of that. Now, let's say the other counterparty is trying to get involved right there in buys. Then what does that look like? Well, that looks like something like the following. Because now we have sells right there. The breakout traders match with buy orders right there as well, where that can even target the swing high right there, whatever they are looking to target. Now, let's say the opposing part that needed that liquidity of those breakout traders is trying to get involved on those buys right there. We now have sellers to our buys right there for central banks, where they can now look to target those swing highs sitting right there. But now it gets important, because if this position right there, the buy position, wants to hit take profit, then they are going to sell at that take profit level. In other words, they need a buyer, an opposing buyer, to sell to at that take profit level. Who can they sell to? Well, by coincidence, we already have someone trapped. Perfect. Let's use them as well to our advantage to sell to. So not only to buy from, but also to then sell to again, where we are buying from them at our entry and their entry level right there, the breakout traders, and we sell to them at the take profit level right there. What does that mean and why is that important? Well, if we are seeking liquidity in the form of this high right there, and we are not offering that fair value anymore, and we are aiming for that high, that means that this right here, the people that are getting trapped, should not be freed of that position, as in they should be trapped. Where let's take this same example right here. When we run this low, we do not have a fair value gap overlapping. But can you see the difference when we trade below this low and this low right there? Below this low, we are comfortable. Below this low, we are not comfortable, and we are immediately trying to seek that opposing liquidity. Why? Because we need that liquidity. Otherwise, we don't have a take profit. So that means that this position, those breakout traders that are trapped, cannot be released. They need to stay trapped until we reach that take profit level right there. If we do release them, for example, right here, we could argue at that moment in time, we might also trap breakout traders right there. But we can see we do not have an opposing aggressive move towards the highs. What that exact opposing aggressive move is something I'm also going to explain, of course. Which means that right there, at this moment in time, if they worry about their position, they can go out and break even. They might eliminate that full position. They can get out of the trade. We do not want them to get out of the trade unless their stop loss gets hit right there. If they are comfortable and they can get out of the trade at any given moment in time, we are likely running the lows. If they are not comfortable and we are trapping them, meaning we aggressively move towards the other side, that's exactly when we are trapping them and when we need their stop loss for the take profit. So again, let's retrace those steps right here to how we can know how we can then target that liquidity and we are not running that low to immediately already continue lower. So how can we know that this fair value gap is not very likely to hold? That is based on we are failing to create a fair value gap exactly overlapping with the lows right there. That indicates that we have somewhat of a lack of intention right there. But that's not the only sign, because then we have the fair value area sitting right there. So we are likely not going to retrace very deep into it. So retrace into that fair value gap is already a little bit suspicious. But then that's not the only part, because then the third part comes in where we need to trap those breakout traders below that low sitting right there. How do we trap them? With opposing intention. What is intention? Fair value gaps. And you can already see me smiling because fair value gaps tell you again everything. And that's why I personally, my whole trading plan is based on fair value gaps. So all I do is indeed talk about fair value gaps with, of course, other concepts in combination with it. The core is always fair value gaps. So what do we see? Well, that intention, if we are trapping people, should be bullish right there. And what do we see? We get a bullish fair value gap right there after sweeping this 4-hour swing low. And that right there for me confirms the sweep of liquidity to then target this swing high right there. So actually, I do not see that fair value gap right there as something we can continue lower off of. No, I see it as resistance, yes, as in we might get a retracement off of that, but I do not expect lower prices off of that. I'm actually looking at higher prices at that moment in time. And the earliest sign where I did not want to look at shorts anymore was when we failed to close with a fair value gap exactly overlapping below that low. That's exactly the moment when you should become suspicious. So remember the previous video actually, where we went over how far price can retrace with a third candle, the fair value gap, where you would require more confirmation. This is exactly, if we still want to continue lower, you should require more confirmation of price. I mainly look at that from the same time frame the swing high is actually on, or a time frame below it. So in this case, you can see I'm switching back and forth between the 4-hour and the 1-hour. So 4-hour swing high, 1-hour sweep, 1-hour fair value gaps, etc. to confirm if we actually want to continue higher, 1-hour fair value area as well. So right now the fair value area is this area right there, which we just created. So if we now want to continue higher, we can continue higher off of that. We also see an order block sitting right there as well. So I'm going to mark out the fair value area a little bit higher right there because that order block, the wick is exactly overlapping with a fair value gap as well. Then we can see at this moment in time, let's replay this actually. We can see at this moment in time, we might create a fair value gap exactly overlapping with that high. So that is quite bullish. That's a good understanding that we might actually want to continue higher. So let's wait a bit. And afterwards, we see right here that we do not create that fair value gap exactly overlapping with that high anymore. Okay, a little bit suspicious, but at that moment in time, do we just switch bearish and right now I forecasted to you that we will continue lower? No, of course not. This is all probabilities. Where if we now want to continue lower and we want to target this low right there, because that's the, again, the fair value area low right now, that's the seeking liquidity low, then we have this whole move potentially to get involved. So why get involved as early as possible right there and try to call a top in the market? That doesn't make sense because at this moment in time, all we are dealing with right there is bullish price action. But can you also remember, we went over as well in previous videos, arguments. We had good arguments right here to continue higher to create a bullish fair value gap overlapping with that swing high right there. As soon as we take that away, we now fail to create that. What is a characteristic of a sweep of liquidity? A fair value gap not overlapping with that exact swing high. Okay, so that creates a bearish argument right there. Does not mean that we are all of a sudden bearish, because at that moment in time, we are still more bullish than we are bearish. Just if you want to look at higher prices, wait for more confirmation. There's no shame in waiting for another fair value gap higher right there to actually confirm that we are now, again, comfortable. Remind yourself of that trap of liquidity, comfortable above that high to then look for higher prices instead. You do not need to be the first one to get involved. Absolutely not. But where you can look to get involved is right now, we can confidently say we are not offering that fair value anymore. Right there. We have a very deep retracement into that. We create a bearish fair value gap as well right there. So we are trapping people. So right here, what do we see? We have this 1 hour fair value gap actually right there, which we can potentially continue lower from. That is where we confirm the sweep of liquidity to continue lower off of that. Is that 100% probability? Absolutely not. That fair value gap might fail right there. So we have to also understand how we react inside that fair value gap right there. Where inside the fair value gap, you actually want to do the same exact thing. Let me show you. Here we are on Euro. Here we are on Euro US dollar on the 4-hour time frame as well. And we can actually see this fair value area right there, which we retrace back into. We are comfortable below the low we took right there as well. We can continue lower off that fair value area right there. We have offered fair value right now. Whilst offering that fair value, we create this 4-hour fair value gap right there. So similar on GBP US dollar, how do we now confirm this 4-hour fair value gap? Well, what creates the low of a 4-hour bearish fair value gap right here, or any bearish fair value gap? The low is created by the third candle high to be specific right there. That third candle high is what? That is a swing high on the lower time frame. So if you struggle with understanding if a fair value gap will actually hold, this understanding helps you in that. Why? So looking at this gray box right there, that's the 4-hour fair value gap. Now on the lower time frame, the low of that 4-hour fair value gap, the third candle high actually, is a lower time frame swing high. The way I like to confirm my PD rays is if it's a 4-hour PD ray, I look at either a 15-minute sharp turn or I look at 5-minute 2 legs lower. So what is the 15-minute sharp turn? Well, if we struggle with confirming that 4-hour fair value gap right there, we can also look at it through this lens. Let's again remind ourselves of those breakout traders right there. Those breakout traders, and we also have this fair value area sitting right there. We can see we are not comfortable above that high right there. And we are also not offering fair value anymore to actually continue higher off of that. We have intention going lower, where people are getting trapped, and that exactly creates a sharp turn. That's so important to understand. The way people get trapped is by fair value gaps as well, because fair value gaps also show you fake intention. A fair value gap in itself shows you intention because it's simply fast price action. An aggressive move is fair value gaps. So if you want to fake people into the market, you want to have a fake out, then you use fair value gaps. Where here, we create fair value gaps going above that high, showing intention. At that moment in time, breakout traders might be getting very excited and might think, oh, this definitely wants to continue higher right there. Whilst we are running into a 4-hour fair value gap, and we are now using the swing high because we are looking at that sweep of liquidity, it might help you to understand when we actually want to trade lower off of a fair value gap as well. Then right here, we do not have an overlapping fair value gap exactly with the high that we just took. And then right there, we see an opposing fair value gap in the making, which is in turn a sharp turn when you have a bullish fair value gap right there and a bearish fair value gap going against it. But is that not a balanced price range? No, because they don't have to be overlapping fair value gaps. A BPR is a sharp turn, correct, but a sharp turn doesn't have to be a BPR. Very important to understand as well, because these fair value gaps don't actually have to be overlapping with one another. And once we have that sharp turn, we are not offering fair value. We are aggressively trapping those traders right there. This is exactly when we can look to trade off of even that first fair value gap already, covering the bodies right there. And you can get even more specific with your stop loss right now because it all connects together. Where if we are trapping those traders right there above that line, then what should we do? We should not release those traders until we reach that opposing liquidity right there. Meaning we should not trade above that line right there. And if we do, then we might actually want to continue higher instead. So our stop loss can be at that high right there because we should ideally not trade above that high anymore. We should not get comfortable above that high anymore. Or sometimes you might still see some wicks coming above it. Wicks is, again, we can argue about that because wicks is universally not agreed across all brokers. So it does not mean that price was actually traded right there. So that is why oftentimes you'll hear people refer to as well, bodies tell the story. So if we trade back above this level with a body right there, then that tells us, okay, that is where the major liquidity was. So that is most likely universally agreed on every single Forex broker that we did trade back above that high. Where wicks can also be manipulation on the broker its side. And by the way, if you're wondering how that then works on indices, if you're trading the CME group, it's a whole different story because that is the price action. That's the real price action right there. Where Forex, you don't have the exact real price action on Euro US dollar right there. So targeting a swing low, I personally like to target a 1 to 2. So I would have my target right there personally to then continue lower off of that right there. Make sure you take into account spread, of course, as well at your stop loss. Otherwise, you might have gotten taken out right there before we actually continue lower. So remember candle signs. Previous candle high, previous candle low is what on the lower time frame? Swing high and swing low liquidity points. So let's look at Russell right here. when we take out that high right there, at first I was potentially looking at a sweep of liquidity right there. I at least wanted more confirmation if we still wanted to continue higher, because we have a first sign right there that actually might be a sweep. Now, to give you as well, of course, an example on a run on liquidity right here, we have this daily fair value gap right there, which on the 4-hour is also overlapping with a 4-hour fair value area right there. That is why I was expecting higher price off of that 4-hour fair value area right there for the MMT. Since this in itself is a run on liquidity and not a sweep of liquidity. That is where we can look to target that high, and at that high is where we would do the exact same thing over and over. See if we sweep or run that liquidity. So back to Russell, we see right there, we are now having a potential sweep of that swing higher right there, but nothing confirmed just yet, because if we still want to continue higher, we also have this order block, that resistance going against us right there. Now, the way candle science works is that if we come into a discount array, in this case on the weekly time frame, we do not necessarily have to continue higher immediately on the first candle. We can still sweep the previous candle low right there to continue higher off of that. How do we know if we are sweeping that previous candle low right there? Let's look at the daily. So on the daily, we could argue that we might have a confirmed sweep at that moment in time, looking to continue lower. The only thing is that we are running into resistance on the weekly. So we have to take that into account. Where right here, what do we actually see? We see we have this swing low right now on the daily time frame, which is the previous candle low on a weekly time frame. So a failure to close below previous candle lows is actually a sweep on the time frames below that. And a failure to close above previous candle highs is most likely going to be a sweep on the time frame below that again. So right here, what I mean by that, we failed to close below that low right there. Then on the daily, what we see is that is actually a sweep, also a failure to close right there below that swing low, sweeping it potentially. Then on the 4-hour, let's look at that in more detail. We see that we have a continuation lower right there. This again creates a sharp turn sitting right there, momentum going into it and momentum right now going out of it right there. Where again, we have that offering fair value story, that breakout story right there. And we see a new fair value area right there with perfect exact swing high overlapping with that fair value gap. And that is exactly what we can now continue higher from, because this in itself is now the fair value area sitting right there. Where what is now the target? Opposing liquidity. We sweep liquidity and we target the opposing liquidity in the form of this swing high right there that we encounter. And of course, on the weekly, that is opposing liquidity. It's even this swing high sitting right there. So if we now want to deliver higher towards that weekly swing high, then what can we see? Well, here, what are we doing? We are creating a fair value area right there in a previous fair value area that we saw towards the left as well. So this fair value area, in about 1 hour, that candle will close. So that will tell us if we are overlapping that exact high with that fair value gap. And if that is the case, that is exactly what we can deliver higher from to then reach this high sitting right there. I can understand that this is quite a difficult topic and it's extremely advanced. So again, take your time to understand this because it will pay off a lot. Trade in line with the higher time frame premise. The reason why this right here is not actually a run on liquidity, why we still continue higher. Yes, we can see it based on the overall understanding of what we just went over, but it's also against the higher time frame premise, which we have talked about on the weekly right there. Understand where the higher time frame wants to go, then understand where the lower time frame fair value areas are if we are running highs, if we are sweeping those highs. Based on that, wait for more confirmation. Based on that, potentially trade the sweep as well and practice and go see it for yourself. Combine this video with the video, the third candle tells you everything. That will also make a lot more sense off of which fair value gap we can actually look to continue higher as well. On why sometimes the fair value gap will not hold, and we can already see that using the concepts here, but also the third candle tells us that already. Then really quick as well, before you go, since we have hit 100k subscribers on YouTube and the MMT is actually 1 year old, we are going to give away with Funded Friends, my upcoming prop firm, a 100k account. And we are also giving away a 1 year subscription for free, of course, towards the lucky giveaway winner. So details to that as well are in the description. It's on Twitter and you can look to enter right there. Then I wish you best of luck and I want to thank you for everything. All right, perfect. Thank you.